Boom! What's going on, Investomaniacs? Your boy Night Rider here, and today we're talking about Tesla. A few days ago, I made a video talking about the successful SpaceX Crew Dragon launch and how I felt how that hurt the valuation of Virgin Galactic and Boeing. What I did not talk about was how that does help the valuation of Tesla. Now, I know what you may be thinking. Wait, SpaceX and Tesla are two completely different companies. Yes, they are both run by Elon, but what does sending astronauts to the International Space Station on a rocket have to do with electric vehicles? Is that what you think?
It doesn't matter what you think!
As far as retail investors are concerned, it does matter, and quite a bit, and the data shows it. Google searches for Tesla stock spiked immediately following the successful SpaceX Crew Dragon launch. Similarly, Tesla's stock rose nearly 8% on the next trading day after the launch, which was Monday, June 1st. The reason is simple enough. While the companies are different, the CEO is the same, and Elon's proficiency in one business or area is considered to be representative of his capabilities and thus would be applicable to his other businesses. Investors think, hey, if this guy can build a rocket with a reusable booster and send humans to the International Space Station, he can probably build a car. And I would agree with that logic. However, was Saturday's launch worth an 8% increase in Tesla's valuation? Not even close. But that doesn't mean we can't make a short-term trade to profit off of emotionally driven retail investors. But now let's talk more about longer-term investing. Should you invest in Tesla right here, right now? Let's take a look at some of the numbers. Tesla's vehicle deliveries are up about 40% year over year for its most recent quarter. That's right here. 88,400 going down to right about here at 63,000 for Q1 2019. This is largely thanks to the success of the Model 3, where deliveries are up 73% for that particular model. While current growth is extremely important, it is even more important that we as investors see a clear path for potential growth going forward. Looking at the big picture first, only 1.9% of vehicles sold in the United States in 2019 were electric, with an even smaller percentage of market share worldwide. That's a lot of runway for Tesla to grow into. Narrowing our focus a bit, the Model 3 has only recently launched in China in 2020, it was early 2020, and if the growth in China is somewhat similar to that of the growth in the United States to date, that is a lot of extra Model 3s being sold. Tesla's China factory has an installed capacity to produce 200,000 Model 3s per year. Tesla only delivered 368,000 vehicles in 2019 worldwide. So you think about it, that's just one factory producing primarily one model, primarily for one market, and that's really going to help your overall business.
That was easy.
Then there's the Model Y, Tesla's crossover. As crossovers are significantly outselling cars in today's United States market, it stands to reason the Model Y will become Tesla's new best-selling model. Now, whether or not this will cannibalize Model 3 sales in a significant way is unknown. It will likely to some extent. It's how much we want to know. But the good news is that the Model Y shares approximately 75% of its parts with the Model 3. Therefore, Tesla should be able to ramp down Model 3 production if necessary. Hopefully that won't be necessary, but if they have to, the good news is they should be able to throttle that down to further increase Model Y production. Initial data from the Model Y has been positive. Tesla released a Q1 2020 update which stated gross margins were positive for the Model Y. This is the first time in Tesla's history a new vehicle model has achieved a positive gross margin in its first quarter. By the way, if you can't see it, that's right here. Model Y gross margin positive in Q1. Unfortunately, I was unable to highlight that. It's not like a highlightable thing. Anyway, let's go ahead and take a look at some of the financials, because obviously, eventually, we actually want to make money, not just have the stock go up, but we actually want some, some real profit to be behind that stock. So let's go ahead and take a look first at the top line. Now, as you can see, revenue growth was super strong all the way up until about 2018 going into 2019, where growth slowed. If we go 2017 to 2018, we have, very roughly speaking, like almost 100% top line growth. That significantly slowed to about 15-ish% going 2018 to 2019. But let's take a look at our operating margin. It's okay if we have the top line slowing down, as long as going more towards the bottom line, things are improving, and that's definitely the case here. Our operating income back in 2017 was negative 1.6 billion, but that improved to about negative $250 million in 2018. We actually saw positive operating income of 80 million in 2019, and that is beautifully increased to $841 million positive operating income in the trailing 12 months. As you can see, obviously operating margin turning positive in 2019 and improving here. And if we come down to the net income, we can see a similar trajectory, losing nearly $2 billion on the bottom line in 2017, improving to down about $1 billion in 2018, despite the top line doubling. So that's good. That improved a little bit in 2019, coming to negative roughly 850 million. And then that's really improved, bringing the bottom line net down to only minus 144 million in the trailing 12 months. We can also take a look at our shares and see we're not experiencing that much share dilution. So that's good. Often in these high growth companies, you're experiencing a significant amount of share dilution, but Tesla is able to get debt. And debt, if you believe in a company, debt is always preferable, provided it's at a somewhat reasonable rate, which Tesla's is. But debt is always going to be preferable to share dilution. So think of it just from a very simple standpoint. If you can get debt for, let's just pick a round number, say 5%. Okay. If you expect your shares to appreciate at more than 5% per year, and I know you Tesla guys, you think these shares are going to appreciate a lot more than 5% per year, you want them taking on debt, not diluting your shares, because that's going to be a lot more expensive in the long run, again, if you believe in the company. And you can see here our operating income turned positive in 2018, and our operating cash flow and our free cash flow turning positive in 2019. So all these numbers are looking fantastic, but we then have to take into consideration, well, how much do we have to pay for those improving numbers? The stock is currently valued at roughly $164 billion. That means you're paying about 6.3 times trailing 12-month sales, which is extremely expensive for a car company, which historically have pretty darn low margins. Now, as Tesla is still losing money, we cannot look at a PE ratio right now because there are no earnings, but we can look at operating income. You're paying about 137.5 times trailing 12-month operating income, which again is very expensive. Currently, I'd say the stock is too expensive.
Don't buy.
You had a wonderful buying opportunity back in the kind of mid to late March time, but the stock is already over 150% up over its March low. So, I mean, listen, you had a great buying opportunity. I say you missed it now. Tesla has historically been an expensive stock, but that's not, in my opinion, a justification to buy it when it's expensive. I think you kind of have to wait for it to come down a little bit. I don't think this is the best time, particularly after it's already kind of recovered all of its Corona loss gains, right? We're back up to the highs. By the way, Elon himself tweeted, quote, Tesla stock price is too high, in my opinion, on May 1st. The stock price was approximately $755 on the open of the day that he tweeted that. He tweeted that intraday. The stock is now at $893 as of the moment of recording this video. So you go, he says it's 755. It's too high in his opinion. And now we're at 892 a couple weeks later. So if you are a big believer in Elon, then maybe you should wait for his advice. I'm not saying don't buy it, but maybe wait for the stock to come down a little bit and then pull that trigger. Hey guys, that's it for this video. I hope you enjoyed it. I'd appreciate a thumbs up and a sub. Peace.